Financial Secretary Paul Chen said that slashing stamp duties on stock transactions will do little to boost the city's slumping financial markets. He blamed geopolitical tensions for hurting investor confidence in the region, but pledged to come up with solutions. Chloe Feng reports.
With China slashing stamp duty on stock trades by half last week, Hong Kong is under pressure to follow suit. That idea gained even further traction after the SAR government set up a task force to enhance stock market liquidity. But Financial Secretary Paul Chen put an end to all rumors today. In his weekly article, he noted the Hang Seng Index plunged 8% alone in August and admitted the situation was not ideal. But Chen argued that lowering stamp duty is not enough to boost transactions in the long run. Citing a similar scenario in the late 90s, he noted daily turnover fell from some $14 billion in 1997 to just $6 billion 5 years later, even though the stamp duty was lowered 3 times during the period. Instead, Chen blamed the geopolitical tensions for hurting the stock market, saying political preconceptions from the West had hurt investor confidence in Hong Kong. The SAR currently charges a levy of 0.26% for each trade, with the cost split between the buyer and the seller. The new rate, which took effect in 2021, had little impact in the first few months. But daily turnover has since slowly declined to $115 billion in the first half of this year. That's 40% lower than 2021 and 16% down from a year ago. The city's stock stamp duty is the second highest among worldwide markets, trailing only the 0.5% in London. By comparison, mainland China only charges 0.05% per transaction. With the high stamp duty here to stay, Chen said there are still other ways to boost liquidity, and the task force will meet this week to discuss them. Chloe Feng, HKIBC.